Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory weekend review video for February 11th, 2023. Okay, let's go ahead and get started. There's our disclaimer. And we didn't have a lot of change from last week, this week. The market is in a strong confirmed uptrend for both indexes, the NASDAQ and the S&P. Our market count now is 7 out of 7, which with 100% exposure. When it goes to 7, it means our power trend is on. And this week, the S&P's power trend did turn on. NASDAQ's was already on. And what that is, it's a buffer. It's when it only turns on when you're in a really strong uptrend. The price is above the 50-day. It's above the 21-day for a certain number of days. The 50-day is in an uptrend, and there's a few other rules that go into it. They used to be very rare, and they've become much more common in the last 3-4 years. But when they do turn on, this shows that you're in a really powerful uptrend. And for our market count system, normally we go to 5 is 100%, but it goes to 7, and it gives you a little bit of a buffer. So you could have a couple sell signals appear and still not affect the count. And the reason why this was put into place is that sometimes you just don't want, maybe just in an uptrend, or you're in a really nice bull market, maybe there's just a week of selling or something happens and it turns out to be nothing in the big picture, but that starts knocking down your exposure when you really should have been just holding with a much larger position. So that's the idea of having that buffer. And it is on, as I mentioned, just for both the NASDAQ and the S&P, and we're basically maxed out. The only caution we have here is our individual stocks and non-index ETFs action signal, which dropped down from, I think it was 35%. It's down to 20. It might have been to 30. I don't remember offhand. This could be almost like a canary in a coal mine situation. We're not seeing individual stocks and the non-index ETFs work very well. There's a lot of volatility around breakouts, and they're not acting well, and there's a lot of just breaking down out of bases. Now, when I mention individual stocks, I'm talking about leading stocks, the stocks that are at or near all-time highs or 52-week highs that are already bucked the uptrend and are already in somewhat of an established uptrend. In other words, they've been above the 200-day, even the 150-day. For at least 30 days, some cases 3 to 4 or 5 months. So they're definitely leading the market, unlike many of the stocks that people are piling back into, the PayPals and the Squares and Atlassian and the Trade Desk, which are in established downtrends, and some of them haven't even broken the downtrend at all. So that's what we're looking at, and they're not acting well, and we've now reduced that to 20%, which has turned our little color coding to red. And that's a pretty big warning, because we're not getting the action. You would think in a big, powerful uptrend like we've been seeing in 2023, you would think that stocks would be really acting well, and they're not. I think part of it is that the money is just flowing back into the beaten down tech stocks and growth stocks and away from others. But we're also starting to see more tech stocks and more kind of growth names, traditional growth names, appear on the list in these stocks, but they're also not working all that well. Because for a while there were a lot of the stocks that were appearing on the leading lists, like in our stock pick service, there were a lot of cyclicals. As the money rotated in the bear market of last year, there were cyclicals. There were chemical stocks. There were defensive stocks like Post Cereal and Clorox. And there were some energy names, things like that, and you weren't seeing really any kind of traditional growth names or tech, anything like that. So now we're starting to see some names, but even those are not acting all that well. So sort of a big warning right there. It could be nothing, but without that, the index, the rally is already a little suspect. So we're going to keep our eye on that, as addition to some other things we're going to talk about. Okay, in terms of our investing strategies, we're doing all pretty good. The QQQ and the SPY are still up nicely this year. Our 1X strategies are lagging a little bit, just because the QQQ just basically went straight up and we weren't fully invested until a little bit later after January 6th. But our 2X has been beating for both actually the 2X is beating on the QQQ, and we're still lagging a little bit on the SPY. We're only a month into the rally, roughly, maybe 5 weeks, call it. And so nothing to worry about, but we'll see. But the idea is also, maybe we might have lagged a little bit on the upside, but we definitely didn't lag on the downside last year. So that's part of the whole point. At times you won't get as good results as just buying and holding, but you're going to avoid those horrific downtrends and down moves that these indexes can make. And you're not sitting there with a big position just getting your equity decimated. Okay, so let's now take a look at each of the indexes. The Dow, interesting enough, was leading for a while. You can see here back in October, really had a nice move, broke out to new highs since April, May. And then since then, it's kind of just gone into a little trading range. It's kind of tightening up here, which is maybe a good sign. The RS you can see is starting to just turn up a little bit, but it's not acting as it was. Now this could be that, again, the money's pouring back into tech names. A lot of the names in the Dow are, more staid, big cap names that are kind of all over the place, but there's a lot of non-tech names in there, so that could be holding that down a little bit. But it's acting pretty good. You can see we're getting support at the 50-day. That's this red line here. There was a little bit of turbulence here back in December, and we got above it. But quickly, the market just seems to be getting support. Buyers are coming back into the market at the 50-day. But we've tested it a lot of times. If we keep testing it too much more, that it's probably not a good sign. Eventually, too many tests, it tends to break. We've seen that over and over in the markets. Now for the S&P, it's acting pretty good here too. We're getting this little bit of a pullback. As of now, we don't know if this is going to be a bigger pullback or not. It wouldn't surprise me if it does turn out to be. I'm still a little suspicious overall of this rally, really going much farther than it has. But anything can happen, so I always try to keep an open mind. Looks like we're getting some support at the 21-day. Now, if we do break this 21-day, we will start getting some sell signals, and our market count will start dropping. But we'll see what happens. And one good thing about this whole rally since January is that we're getting a lot more up days on higher volume, which is showing that there's institutional buying, institutional support, and we definitely need that in the markets to continue higher. And so we're getting a lot more of that and very little distribution or up days on higher volume, or down days on higher volume, sorry. And so we have a very small amount of distribution, which is really good. So overall, this rally here has really not seen any wide-scale selling by institutions, and much more on the buying side. So that's a really good sign for the rally. Let's move on to the Nasdaq. Now, Nasdaq is getting a little bit more of a decline now. You can see the RS is starting to drop versus the S&P, so it's kind of underperforming. But we're well above the 200-day, which is still in a downtrend. So you have to respect. Let me go back to the S&P. We're still in a downtrend. The 200-day, which is the black line, is still trending down, even though it's starting to kind of flatten out here. Now, until we're really into an uptrend, and in other words, we stayed above here long enough that the 200-day starts turning up. You still have to treat this as a downtrend, and we're basically in a bear market, even though the Nasdaq is very close to actually giving the technical definition of a bull market, up 20% from the low. So we're actually pretty close there. We got close over here, and we pulled back a little bit. So we'll see what happens. But we're still in downtrend, so we have to be a little careful there. This hasn't really broken any of the downtrend that we've had since the bear market started. And we've got a little bit of distribution here too, but you can see just from the big blue spikes here, we're getting a lot more buying coming in. So a little bit of a mixed picture. We don't know how far this is going to go down. It could be over. We do have on Tuesday that big CPI number is going to come out, and again, it's probably going to be another big market mover, one way or the other, or both ways. Initially, we've been seeing that, so we'll see what happens there. And then finally, we have the Russell. Slightly weaker. Came down to support the 21-day. It's the green line here, and it didn't quite be able to clear its August high. And we're seeing a lot more small cap names started to appear in our lists in our stock pick service, but again, they're not acting all that well, so it's hard to tell what's going to happen there. Okay, let's move on to the technicals. Now, these have greatly improved over the last few months. The percentage of stocks above the 200-day, we got up to 66 about a week ago, which is really, this was down in the 20s. I think it was even in the teens briefly, really, really low. So this is really came powering back. The number of 52-week highs for just week after week after week, the lows were outpaced by the highs, and we turned that around a couple weeks ago, even though we're starting to now turn around and go back to the more lows than highs. So a little bit of weakness appearing here. As you can see, the NASDAQ percent above the 50-day has now come back. It was really pretty overbought here when it was almost 11%. That's usually when you get to about 8 or above, you're kind of pushing it. That's when the sellings come in, and it kind of did on pretty much like clockwork. And up volume, yes, you can actually just see here from the ratio. We're starting to get a little bit of a turn here, even 7 days ago. So that little bit of a warning. We don't know if this is going to turn out to be that was the peak, and we're going to kind of correct back down again or not. So we're sort of in that no man's land, which I talked about last week, which is kind of the most dangerous part of the market. You just don't know what's quite going to happen, and I'll talk a little bit more about that in a minute. And then here, finally, for sentiment. This really probably got a little ahead of itself. Just this week, we were in extreme greed on the CNN Fear Greed. This has a lot of things in it, including percentage of stocks above a certain way. There's like 6 or 7 items that go into this, and some of it is bond related too. But it's very good just overall, kind of showing that this really just really moved pretty rapidly. Probably ahead of itself. And we are seeing, pretty much across the board, it's all gotten pretty bullish, maybe getting a little excessive too. But you never get super clear pictures with this unless you're at a real turning point where it's just panic across the board. That's really the strongest, most powerful sentiment signals on the downside. And we've seen that a few times. I talked about in the past, during the coronavirus crash, the CNN Fear Greed went to 1, which was just like absolute panic going on. And that was pretty much the bottom right there. But on the other side, you can have these extreme greed and very high numbers for a long, long time. And that does not really a sign of, it gets there, it's time to sell and get out, because it can stay up there for weeks and weeks and months. That's something I learned long ago when I was just learning how to trade, and I remember kind of studying all these different indicators, including stochastics and MACD and all that, and I thought, oh great, look at this stochastics. Look, it seems, in hindsight, when you look at it, you go, seems it goes up, and then as soon as it starts turning down, that's the top. And so it looked like it was really easy. Well, of course, it's never that easy. But I remember this was in the late 90s. I thought, okay, I was interested in AOL, which was like one of the hot stocks at the time, and I sat there and watched it, and it was already overbought on that particular stochastics indicator. So I thought, okay, I'm just going to wait till it comes down, then I'm going to buy it. And that the stochastics stayed overbought for months, and you just couldn't buy it. I forget, say the price was 50. By the time it actually came down, I thought, well, now it's time to buy it. The stock was like 150. So, and I realized that just really doesn't work. So on the upside, yeah, it's a tricky one to use these indicators, which is why a lot of them are kind of worthless. So, but we try to look at 3 or 4 or 5 of these in conjunction to kind of get an idea what's happening with sentiment. Now, in terms of the VIX, this has been kind of finally creeping down to not just solid red. We showed you this was solid red it's been over a year, so we're starting to see a lot of that panic in bearishness just kind of starting to fade away. You can see we've got a little bit started here, but it's gone back into the red. And this is a chart I showed last time of the volatility. And this is another little concerning area here. You can see here in the pink areas, whenever the VIX has gone down to between 16 and 19, in other words, we're got down below 20, and we were able to get down there. For the last 4 periods it's done this, that was the peak of the market. So here's the S&P, and you can see this black line here. You can see here the first one, it got down to 16 and 0.35, looks like that was the peak. Another rally had up in April, got down to just looks like 1845. That was the peak of that. We got down to 19. There we go. And then here we actually got down to I think it was 18.33. No, I'm sorry, a little bit lower than that. I don't have the exact number on this chart. It looks like it was around 17 or so. And now we're starting to come down on the S&P, but we're starting to come up back here. Now again, we don't know if this is going to be the 4th time this pattern works, but it's something to be concerned about, because the VIX, basically when the VIX is down here, there's a lot of complacency. And we're seeing that also how quickly the sentiment has jumped up. These went into greed. The percentage of stocks on the technical side and the 50-week highs, just everything got really bullish, really pretty quickly, maybe too quickly. So a little bit of a little warning there. And just a few more warnings. This is the warnings video. This has sort of been the junk off the bottom rally. And in the S&P 500, 48 of the last year's 50 worst performing stocks are up this year on average about 17%. And on the other side, 30 of last year's 50 best performing S&P stocks are up only an average of 1%. So you can see that the money just piling back into what's considered cheap, quote unquote cheap. And unfortunately, this is another warning that is a little more concerning, is we're getting the investors piling back into meme stocks. Even Bed Bath & Beyond, which has just been warning about its bankruptcy looming, and traders are just piling in and out of this. And that's a concern, that it didn't take much more than a month of the market having a follow-through on January 6th to just see all the speculation come back into the market. That's concerning. So if you look here, all 10 of the top performing S&P 1500 stocks really got pounded in last year. This year, the same stocks are up 70% on average, but they fell about almost 70% last year. And one thing we have to notice too is that it's not like these are really the best outperforming stocks. Most of them, like if you take a look at charts of PayPal and many of these Appfolio, and I can't think of the names offhand, but they're nowhere near their old highs. Most of them are still down an average of 42% from their all-time highs. And we can also see that Cathie Wood with her ARK fund is back sort of in the limelight. She's been loading up on you can call it quote unquote riskiest stocks, including Tesla, and she's up 35% already this year. And that's even beating the S&P 500 high beta ETF, which is full of the riskiest S&P 500 stocks. So really kind of concerning that that's what's happening. This could be the bottom, could be that, the bottom fishers buying these things that was considered, the stock was 300 and it's 48, I'm going to buy it. Well, remember, these are the same ones that people that were buying it all the way down from 300, they bought it at every little dip in the chart. And when it started to turn back up, a lot of people just lost a ton of money doing that bottom fishing. So you have to be a little concerned, excuse me, about doing that. It's a very tricky trading strategy, and for most people, you end up losing most of your capital. So be very careful about that if you're tempted that, or that's what your investing strategy is. So just finally, again, I've talked about this for the last few weeks. We're at that dangerous make or break point in time. There's a lot of volatility, and remember, the volatility is not our friend. You don't want volatility. Volatility will just end up, it's just noise. It'll end up kicking you out of stocks, which is what we're seeing more and more. It just, you'll see just, there was another article I read. I think the number of days NASDAQ has moved 1% either up or down is like almost every single day this year. And it really the market really needs to calm down to be much more of a safer trading rally if we're going to continue up, because the volatility is really just chopping up a lot of people. So you have to be real careful about that. And, all in all, though, I mean, personally, I'm not very bullish on this market. I would not be surprised at all to see it come back down. But, at the same time, you have to respect the trend. If you ever read, a great read is the Market Wizards books. There's, I think, 3 or 4 of them. Excellent reads. They're if you were taking a course in investing, that's on the mandatory reading list. Those, and they're everything from individual stock traders to hedge funds to people that were trading bonds, futures, everything across the board. And they all talk about that. The volatility is really will kill you. But the number one thing is that they all said, and ultimately they learned their lessons. And the number one thing was you have to respect the trend and what the market's telling you, and not what you think it's going to do. You'll read about tons of wipeouts. We're talking about people that millions and tens of millions of dollars would wipe out and come back and wipe out, until they finally got that, hey, you know what? We can't just put on either, these giant all or nothing bets, and just hope that we're going to, sure, you might be lucky and, make a windfall killing, but on the other side, you can wipe out. And the books are full of that because ultimately the traders were not respecting the trend. One of the biggest ones is people that just are bearish on the market and just short everything. And in fact, I came across the book recently, and one guy said he was shorting, I think it was AOL of all things, and he just said this was ridiculous numbers. The whole stock was just being evaluated by eyeballs, not the number of people that are even coming to the site necessarily, but just other metrics that had no bearing. Sales, earnings, nobody cared about that. And so he said, this is ridiculous. Let's say the stock was at 50, probably was. And he just said, I just kept shorting it. And then the news kept coming out. And he said it was crazy. The whatever multiple, let's say it was 100 times sales. And he goes, it was just stupid. So I shorted it. And, and finally, when it was 150 times sales and the stock was up, 200% higher, I realized that I made a mistake and I lost, most of my money, kind of story. So, you can't do that. It's just, you're asking for trouble. So again, you respect the trend. The trend is up right now, and we even have power trends going on. So, this is not the time to be trying to short the market. If anything, if you were, this is a time maybe to take some profits off the table, especially now we're starting to get into correction. If you even have profits, it's been difficult to amass much more than a 10% move in many, many stocks, unless you're buying, the beaten down ones where you have Tesla's up 100%. So, but again, where was the bottom? Sure, this was the big move, but, go back a year and you didn't get those moves, and if you hung on too long, you were looking at, double digit, losses. So again, just to wrap it up, we've got to respect the trend. It is up right now, and that's what the market is telling you. And you just don't fight it and think you know better. The market's wrong. The market's never wrong. It's doing just what it's doing. What will be wrong is your interpretation of it and then betting your money against the market. It's something that is very dangerous. And while occasionally you can be lucky, most of the time you're going to be giving yourselves a lot of problem. So what we want to do is we ride the trend up as long as it continues. And eventually, if the market fails, you'll start seeing our market count signals starting to drop. Eventually, they'll go down to 0. And if it doesn't, this uptrend could go on for a year, 2 years. So you never just want to be thinking, oh, I know better, and this can't go any higher. Markets can do anything. You just never know what can happen. So you never try to guess. Everyone, including myself, made the mistakes of thinking, oh, this is bad news, I'm getting out. And it turned out that bad news turned out to be like one of the, in retrospect, some of the best news the market's ever got. So you don't want to be in that camp of just, and again, that's letting your emotions take control instead of looking at what's actually happening and letting push the emotions aside and say, hey, this is what's happening. I just need to be bending and swaying like the wind with the market. And that's how people do well over time, is by they just are not marrying themselves to one point of view that will just either will eventually cause them a lot of problems. Okay, so next week we'll be back. We'll see what the market does. Again, on Tuesday we have that another big economic report coming out that's going to move the market, and we'll see what happens. And until then, best of luck trading and making some money out of this market, and we will talk to you next week. Okay, thank you.